There's something about a big dividend that just grabs you. The bigger the payout, the harder it is to look away. And one of these 5 pays almost 66% a year. So John puts it to the test. $100,000 into each of these 5 ranked from the safest one to the riskiest, just to see what that chase actually gets you by the end. In this video, John's going up the whole ladder, ranked from the calm, boring payer at the bottom to the almost 66% high yield at the top, $100,000 in each. You'll see what each of these high-yield stocks is really about, the risk lever, how it actually performed, and in the end, how one of them is projected to pay $65,000 in annual dividend income, or about $5,400 a month. By the end, you'll see exactly how real it is. Now, before John touches a single one of these, there's one pattern you need in your head. It's this. As the dividend gets bigger, everything around it gets shakier. The safety scores start sliding. The years of steady dividend growth dry up to nothing. Even the short sellers, the investors betting these things fall, show up heavier the higher the yield goes. So here's the one idea to carry all the way up the ladder. A yield is a worry meter. The bigger the number, the louder the market is telling you something underneath might not hold. Keep that in your head, because John's about to climb it from the quiet end to the loud one stock at a time. First up is Realty Income, ticker O, pays 5.4%, the smallest yield on the whole list. John looks at that and kind of shrugs. 5%? Come on, he came for the 66%. This feels like the slow lane. But here's why O earns its spot. This is what a dividend you can actually lean on looks like. It's a property company. It owns the buildings your pharmacy and your local stores pay rent in. And it has raised its dividend every single year for 32 years straight. It just bumped it again last month. The payout eats up about 3/4 of what the company earns, so there's real room left underneath it. And look, it's not flawless. Seeking Alpha only grades its dividend safety a C, and its revision score just slipped to an F. So even the steady one at the bottom has a soft spot. Worth remembering, because if the calm stock has cracks, wait till you see the top. So here's how John's $100,000 actually did. The dividend paid him about $5,400 over the year, roughly $450 a month. The share price barely moved, up a touch under 5%, so about $4,600 in gains on top. Add it together and that $100,000 turned into around $110,000, up 10% in total return on the year, all in. Realty Income is safe because it owns real buildings with real rent coming in. That safety is the exact reason the yield stays small. You can't get paid much more without giving something up. So what does John give up to nearly double the income? On the next one, he stops being an owner and becomes the bank. Main Street Capital. Main, M-A-I-N, looks like a straight upgrade. It pays 8.59%, nearly double Realty Income. And Seeking Alpha actually grades the yield itself an A. John likes that a lot, but he pauses. If it's paying almost double what O pays, what is he not seeing? Here's what. Main is a BDC. It lends money to mid-sized companies that can't easily walk into a regular bank. So John isn't an owner here, he's the lender. And lenders do great right up until somebody can't pay them back. And the warning lights are right there on the page. Seeking Alpha's quant model rates Main as a sell. Out of more than 4,000 stocks it scores, Main sits right around 3,600th. 1 in every 10 of its shares is sold short. That's a lot of people betting it drops, and the analysts can't agree with each other. One just called it the best BDC on the market, while another, the same week, warned of serious downside hiding under the surface. So how'd the year actually go? Well, the dividend was solid, about $8,590 in John's pocket, roughly $716 a month. But the share price dropped almost 13%, which wiped out close to $12,900 of his $100,000. Do the math, and even with all that income, that $100,000 shrank to about $95,700, down 4% on the year. He collected every dividend and still ended underwater. The bigger payout didn't save him. Real quick, before we keep going, this one's sponsored by Seeking Alpha. Every grade you've seen, that sell rating on Main, all of it came straight off here. And that's just the start of what they do. They've got a stock and ETF screener that finds picks based on exactly what you're after. And their alpha picks? Well, those have beaten the S&P 500 by over 340%. If you want all of it, their summer sale is on right now. And if you use my links in the description or the pinned comment, you get the best discount out there, 25% off premium. Want their stock picks too? The alpha picks and bundle links are right there next to it. It wraps up July 7th, so go grab the discount link. Okay, back to the ladder. Main's risk is whether its borrowers keep paying. But here's the part nobody warned you about. Even when the dividend keeps showing up, the price underneath can keep shrinking. Now, the next stock pays even more, and this year, it did something that's genuinely going to mess with your head. AGNC. It pays 13.87%, the biggest yield John's hit so far, about 2.5 times Realty income. John's leaning in hard now, a near 14% monthly payout. He wants to know what's holding it up. So look under the hood. AGNC pays out 96 cents of every dollar it earns. There's almost nothing kept back to grow on. It's never raised this dividend. It's actually cut it. Watch the chart. The payments step down over the years and then go flat. The share price has roughly halved over 5 years, bleeding the entire way. And to keep those checks going out the door, the company just opened the door to selling up to $2 billion of new shares. So everything underneath says danger, every single signal, which is exactly what makes the results so hard to believe. Because watch what the year actually did. The dividend paid John about $13,870, roughly $1,156 a month. And this year, unlike Maine, the price went the right way, up about 12%, adding another $12,000-ish on top. Put it together, and that $100,000 grew to around $126,000, up 26% in total returns. Well, John lights up. It pays a fortune, and it had the best year. So why isn't everyone piling in? Here's the catch. AGNC paid him this year for a risk that happened not to bite. The machine underneath has been wearing down the whole time. And that's the entire story of the stock waiting for us at the top. So John's halfway up the ladder, and so far the twist is that the scary high-yield stock, AGNC, actually had the best year of the whole bunch. So maybe chasing the big number works after all? Hold that thought, because the two biggest payers are still coming, and the one right at the very top, the one paying almost 66% that John came here for, is the strangest result on this entire list. What happens when a dividend is so big, it can drag a losing year back into the green? That's PDI, the PIMCO Dynamic Income Fund. Second highest payer on the list, 16.19%. But PDI hides its cost in two places you'd never think to look. First, you're paying more for it than it's actually worth. The stuff inside the fund is worth $15.80 a share, but it trades at $16.34. That gap is the 3.42% premium. You overpay just walking in the door. Second, the fee. 4.5% a year, gone before you ever see a dividend. And that's not a typo. Most index funds charge a tiny fraction of that. And yet, here's the twist that matters. Watch how the year played out. The share price actually fell, down about 12%, taking roughly $12,300 off John's $100,000. But the dividend was enormous, about $16,190 in cash, around $1,349 a month. And that payout was big enough and real enough to not just cover the drop, but push past it. Netted out, and the $100,000 ended around $104,000, a small win clawed back entirely by the fat, very real dividend. So far, every one of these handed John actual money, real income, and when the price fell, like with PDI, that real dividend could bail him out. Hold that idea tight, because the last stock breaks it. It pays the most of all five, and its income? Wait till you see where it actually comes from. Here it is, the one John's been waiting for since the beginning. MSTY, the YieldMax MSTR Option Income ETF. The headline number it shows is a wild 267%, but that one's looking backward at a year when the price was actually way higher. The forward rate, going in today, is about 66%. Both are real and both are enormous. Either way, on $100,000, that's roughly $65,750 a year or $5,479 a month. John's basically reaching for his wallet right now. This is the number that pulled him up the entire ladder. But here's where it cracks open. This fund actually earns, in real income, about 1.5%, 1.5, and it pays out 65.75. So where's the other 64 points coming from? Because that money has to come from somewhere. It's coming from John, from his own pile. The most recent payout was almost 97%, something called return of capital, which is a polite way of saying they handed him back his own money and stamped the word dividend on it. It's like pulling cash out of your own savings account and celebrating the interest. And the price tells the rest. A year ago, one share of MSTY cost $115. Today, it's $15. Yeah, from $115 down to $15. That's not the kind of dip you bounce back from by Friday. So put it all together, the same way we did every other stock in this video. The price didn't just dip, it collapsed down almost 85%. That alone vaporized about $84,700 of John's $100,000. Now, the dividend was still huge. He collected around $40,900 in cash over the year, but that's nowhere near the $65,750 the almost 66% headline promised. Here's why. That big yield gets measured against the share price, and the share price was falling off a cliff all year long. So every check got smaller as the price dropped. The advertised number assumes the price holds still, but it didn't, not even close. And even $40,900 of income couldn't save him. You can't out-earn a wipeout like that. Net it all out, and the $100,000 ended worth about $56,000. Read that again. He pocketed $40,000 and still lost more than $40,000. The income this thing advertised for a single year is actually bigger than whatever he has left. And here's the part that ties it all together. Seeking Alpha hands MSTY's dividend an A+, its highest possible grade. But that grade is only measuring one thing, the size of the payout. And the payout is enormous, so A+. However, it says nothing about whether you'll keep your money. For that, look at the overall rating. Strong sell. Dead last. 512th out of 512 funds in its class. So the two grades aren't fighting each other, they're telling you the exact same thing from two angles. Yes, the check is huge. And no, you should not be anywhere near this. It barely even holds the thing it's named after. It's mostly sitting in treasury bills with a sliver of options stapled on the side. Now, remember PDI? Its dividend was big enough to rescue a losing year because that money was real. MSTY's dividend couldn't rescue anything. It wasn't growth. It wasn't even income, not really. It was John's own savings walking out the back door 1 week at a time. The biggest number on this whole list, the one he chased the entire climb, turns out to be the one that would have cost him the most. So line up all 5 one last time. John ranked them by payout, smallest to biggest, fully expecting the fattest checks to win. Well, they didn't even come close. The boring 5% payer, Realty income, slowly grew his money to $110,000. The scary mortgage REIT, AGNC, won the entire year. And the 66% monster he actually showed up for, well, it took the most. The boring one grew. The scary one won. The monster bled him out. Here's the whole thing the climb was trying to show. A yield is actually a worry meter. The bigger the number gets, the harder the market is waving you off. And at the very top, the payout stops being income at all and turns into your own money handed back to you slower than it's disappearing. John climbed this ladder wanting the biggest number he could find. He's leaving wanting the one he can actually trust. Funny how that flips. But what if that same $100,000 went into quality instead? 5 of the best REITs. Click the video on the screen and I'll show you a REIT that's projected to turn $100,000 into a $6 million portfolio that pays over $11,000 a month.